Pause for a moment. Don't refresh your chart. Don't trust the price you're seeing, because while silver collapsed on your screen, something very different was happening behind the scenes. A 250% surge in physical demand. At the exact same time, paper prices were crashing. That's not normal. That's not a correction. That's a structural event. Someone was forced to sell. Someone else was prepared to buy. And the real story isn't in the candle. It's in who now holds the metal. Because when demand explodes during a crash, it means something is being hidden. And by the time the price reflects the truth, the opportunity is already gone. Welcome to Market Metal. If you're someone who's seen a few market cycles, if you've learned that headlines lie but structure never does, then you're in the right place. Please subscribe to this channel, not for hype, but so you don't miss the signals that matter before they show up on the price. And tell us in the comments, where are you watching from today? New York, London, Dubai, Mumbai, or somewhere else? Let's get into it. The event they framed as volatility. It was Tuesday morning, February 3rd, 2026. The smoke had finally begun to clear after one of the most violent trading sessions the silver market had experienced in years. For those still watching their screens, still holding positions, still standing, this was survival. What unfolded the day before would later be labeled by headlines as extreme volatility. To a trained observer, it looked like something else entirely. At exactly 10 a.m. Eastern Standard Time, the market experienced a high-speed collision. Two powerful forces hit at the same moment. A massive liquidation wave from the Indian physical market collided with freshly released United States manufacturing data. The result was not a gradual sell-off. It was a sudden collapse, measured in billions of dollars of paper contracts, executed in minutes. To the casual investor, the chart told a simple story. Prices fell sharply, panic followed, positions were closed, accounts were wiped out. But this surface narrative missed the deeper truth. Markets do not behave this way without reason. Prices do not fall vertically unless structure fails. This was not random selling. This was not fear spreading organically through traders. This was a mechanical breakdown. The first mistake made by most observers was assuming that price equals value. In modern financial markets, price is often nothing more than the last transaction between leveraged participants. Value, especially in commodity markets tied to physical supply, is determined elsewhere, often far away from trading screens in New York or London. What happened that Monday was not a rejection of silver as an asset. It was a forced liquidation inside a paper system operating far beyond its physical limits. To understand why the floor gave way so quickly, one must begin in India. When markets opened in Mumbai, dealers reacted to mounting uncertainty around upcoming union budget announcements. Fears of changes to import duties triggered aggressive profit-taking. Inventories were dumped. In a single session, prices in the Indian physical market fell sharply in local currency terms. This alone would have been manageable. India often sells into strength and buys into weakness. But this time, something critical broke. India is not a side market. It is one of the primary lungs of global physical silver demand. When India slows, the global market struggles to breathe. Normally, sharp price differences between regions are corrected through arbitrage. Traders buy where prices are low and sell where prices are high. This mechanism keeps markets connected. On this day, that bridge collapsed. The price gap between physical silver in the east and paper silver in the west widened too fast and too violently. Volatility spiked. Risk limits were breached. Arbitrage algorithms, designed to function only within defined parameters, shut down. When liquidity providers step away, markets do not drift lower. They gap. This was the first structural failure. With the arbitrage channel offline, price discovery was left entirely in the hands of paper traders in Western markets. At the same time, a second force entered the system. News circulated that Kevin Warsh had emerged as the leading nominee for the next chair of the Federal Reserve. To human observers, this appeared to be political speculation. To algorithmic systems, it was a regime signal. Trading models interpreted the nomination as a shift toward a stronger dollar policy. Warsh was coded as a hawk, someone willing to prioritize currency stability even at the cost of market pain. Within seconds, currency algorithms adjusted. The dollar index strengthened. And in the world of cross-asset trading, a stronger dollar automatically pressures commodities priced in dollars. This was not discretionary selling. No trader woke up that morning deciding silver had lost its relevance. The selling was automatic. Code executed instructions based on correlations, not fundamentals. High-frequency trading desks initiated large, short programs. They were not making a judgment call on silver supply or demand. They were responding to signals embedded deep inside their systems. When the dollar strengthens, metals weaken. That was the rule. The market was already wounded from the Indian liquidation. The Warsh signal pushed it closer to the edge. Then came the trigger. At 10 a.m., the Institute for Supply Management released its manufacturing data. Whether the number printed slightly above or below expectations mattered less than the reaction it caused. Volatility surged instantly. For leverage traders, volatility is lethal. Stop-loss orders, placed by thousands of retail and institutional participants, began to trigger. One level fell, activating market sell orders, which pushed the price down further, triggering the next layer of stops. This created a cascade known as a long squeeze. In a market with buyers, such selling would be absorbed. On this day, buyers were scarce. Liquidity had already retreated. Millions of ounces of paper silver were dumped into a vacuum. This is why the price did not slide. It fell vertically. Yet this is where the story diverges from the mainstream narrative. While retail traders were forced out, selling not by choice but by margin calls, another class of participant was active. Deep in the order book, large limit buy orders waited patiently. These orders did not chase price. They absorbed it. This pattern is familiar to those who study market structure. It bears the signature of commercial entities, bullion banks and large institutions that had been holding significant short exposure for months. As prices collapsed, these entities used the panic to cover their positions. In simple terms, the forced selling by leveraged traders provided the liquidity that institutions needed to exit their shorts at favorable levels. Paper liabilities were exchanged for physical claims at a discount. This was not chaos, it was a transfer. The scale of leverage made the outcome inevitable. The silver market operates with an estimated paper-to-physical ratio exceeding 300 to 1. For every ounce of registered physical silver, hundreds of ounces of paper claims exist. In such a system, volatility does not reflect changes in supply or demand. It reflects stress in the leverage stack. As prices fell, margin clerks issued calls. Traders unable to post additional collateral were liquidated automatically. This forced selling fed back into price declines, triggering more margin calls in a self-reinforcing loop. The process had nothing to do with silver itself. It was about solvency. When the dust settled, the chart showed a deep red candle. To many, it looked like destruction. But charts do not show ownership. They do not show who now holds the metal. Weak hands were washed out. Leveraged players were removed. Entities with long-time horizons and deep capital pools stepped in. This is why framing the event as volatility is misleading. Volatility implies randomness. What occurred was structural. The paper market buckled under its own leverage. In doing so, it created the conditions for accumulation. The critical question moving forward is not why the price fell. That question has been answered by mechanics, not emotion. The real question is this: now that the forced selling is done, who controls the remaining supply? To answer that, one must look beyond the price chart and beyond the Western trading screen. The structural failure beneath the price. What made the collapse of Monday so dangerous was not the speed of the fall, but the illusion it created. To anyone watching price alone, it appeared as if confidence in silver had evaporated overnight. In reality, confidence did not disappear. Liquidity did. Markets do not collapse because people suddenly agree something is worthless. They collapse when the systems designed to absorb stress stop functioning. What happened beneath the price that day was a textbook example of structural failure, one that most participants never see until it is already too late. At the core of the breakdown was a simple truth that modern traders often forget. Not all liquidity is real. Much of what appears on a trading screen exists only under calm conditions. When volatility rises beyond a certain threshold, that liquidity vanishes. The first layer to fail was the arbitrage mechanism connecting physical markets in the East with paper markets in the West. Under normal conditions, this bridge is invisible. Prices stay aligned because traders exploit even small differences. If silver is cheaper in Mumbai than in New York, buying pressure appears in India and selling pressure appears in the United States. Balance is restored. On Monday, balance was not restored. The price gap widened too quickly. Risk models flagged instability. The machines that normally step in to smooth markets were programmed to protect capital first, not maintain order. Faced with extreme spreads and accelerating volatility, they disengaged. When that happened, the global silver market fractured into isolated zones. This is a critical point. Once arbitrage shuts down, price no longer reflects global reality. It reflects only the conditions inside each isolated market. In New York, that meant a paper-heavy system dominated by leverage, margin requirements, and automated execution. There was no physical anchor left. At the same time, currency markets were amplifying stress rather than absorbing it. The potential shift in Federal Reserve leadership was interpreted by algorithms as a change in policy direction. Models do not wait for confirmation. They act on probability. As soon as the likelihood of a more hawkish stance increased, the systems adjusted positions across asset classes. The dollar strengthened. That alone was enough to trigger selling in metals. This is where the fragility of cross-asset trading becomes clear. Silver was not sold because its supply outlook worsened. It was sold because it sits on the opposite side of a currency equation embedded in trading code. The metal became collateral damage in a larger macro repositioning. Once selling began, it fed on itself. High-frequency systems operate on momentum and volatility. When prices move rapidly, these systems increase activity. They do not stabilize markets, they accelerate trends. As price broke through key technical levels, sell programs expanded. Each new low confirmed the model's bias. This would have been survivable in a market with depth, but depth had already retreated. The leverage embedded in the silver market turned a sell-off into a cascade. For years, participants had grown comfortable operating with extreme exposure. Paper contracts multiplied far beyond physical availability. As long as prices rose or moved slowly, this imbalance remained hidden. When prices fell sharply, leverage became a weapon. Margin requirements forced action. Traders were not making decisions. Decisions were made for them. Positions were liquidated automatically, regardless of price. In those moments, selling is not strategic. It is compulsory. This distinction matters. A strategic seller chooses when and how to exit. A forced seller accepts whatever price the market offers. On Monday, the market offered very little. Yet while forced selling dominated the headlines, another process was unfolding quietly. Volume analysis from the session revealed something unusual. Despite the violence of the move, large blocks of buying appeared at specific levels. These were not reactive trades. They were pre-positioned. Someone had anticipated disorder and prepared for it. This behavior is characteristic of entities that understand structure rather than sentiment. Large commercial participants do not chase prices. They wait for stress events that allow them to rebalance exposure on favorable terms. For months leading into the crash, these institutions had carried significant short positions. Rising prices had placed them under pressure. The sudden collapse gave them an opportunity. As retail and leveraged players were forced to sell, these entities absorbed supply. The result was a quiet shift in positioning. What looked like panic selling on the surface masked a deeper transaction, the exchange of leveraged paper claims for long-term ownership. This is how markets reset without ringing a bell. The leverage ratio explains why this reset was so violent. With hundreds of paper ounces trading for every physical ounce available, even a small disruption can have outsized effects. When confidence in liquidity fades, participants rush to reduce exposure simultaneously. This creates a feedback loop. Falling prices trigger margin calls. Margin calls force selling. Forced selling pushes prices lower. The loop continues until sellers are exhausted. Importantly, this process has very little to do with the underlying asset. It is driven by balance sheets. This is why the red candle on the chart should not be interpreted as a loss of faith in silver itself. It was a mechanical purge of excess leverage. The system expelled participants who could not meet its demands. Such events feel chaotic to those inside them. To those studying market structure, they follow a recognizable pattern. Every highly leveraged market eventually faces a stress test. When it does, price moves violently, not because fundamentals change overnight, but because the scaffolding holding the market together collapses under pressure. Monday was such a test. The question now is not whether the damage was severe. It was. The question is whether the failure was terminal or corrective. History offers two paths. In some cases, a structural failure marks the end of a cycle. Liquidity does not return. Confidence remains broken. Prices drift lower for years. In other cases, the failure cleanses the system. Excess leverage is removed. Stronger hands take control. The foundation is rebuilt. Which outcome follows depends on forces that charts alone cannot show. To determine that, one must step away from Western trading desks and look at where demand originates and where metal ultimately flows. The next stage of this analysis does not begin with price action. It begins with ownership. Because while the paper market was imploding, something else was happening, something far more telling. Physical demand was not retreating, it was accelerating. The demand signal the market is ignoring. While screens in New York flashed red and commentators argued over charts, a different story was unfolding far from trading floors. It was quieter, slower, and far more important. As paper prices collapsed, physical demand did not retreat. It surged. This is where the narrative breaks. In most markets, falling prices signal falling interest. Sellers overwhelm buyers. Inventories build. Confidence erodes. That is how a true bear market behaves. What happened after Monday's crash followed a very different pattern. Within hours of the sell-off, reports from physical dealers told a contradictory story. Phones rang nonstop. Inventory was requested, not returned. Premiums widened instead of shrinking. The lower the paper price went, the harder it became to source real metal. This was not coincidence, it was signal. To understand why, one must separate two very different types of market participants. On one side are financial traders. They operate with leverage. They respond to price, volatility, and macro signals. On the other side are physical buyers. They respond to necessity. Physical buyers do not care about 5-minute candles. They care about supply security. This distinction explains why the crash failed to suppress demand. In fact, it triggered the opposite reaction. When paper prices fell, physical buyers did not see risk. They saw opportunity. This is especially true in Asia. In Shanghai and Mumbai, silver is not treated as a speculative instrument. It is treated as inventory. When prices run too fast, buyers step back. When prices fall sharply, they step forward. Their behavior is cyclical, disciplined, and largely disconnected from Western financial sentiment. For the last 2 years, this behavior has expressed itself through a persistent premium in Asian markets. The Shanghai Premium, where silver trades above prices in London and New York, has become a structural feature, not a temporary anomaly. This premium matters because it reveals where true demand resides. When silver trades higher in the East than in the West, physical metal moves east, bars leave Western vaults and do not return. They are not being leased, they are not being rehypothecated, they are being stored. This creates a one-way flow. Monday's crash did nothing to reverse that flow. In fact, it accelerated it. As paper prices fell, the gap between spot prices and physical premiums widened. This is the textbook definition of decoupling. Decoupling occurs when the price of a promise diverges from the price of delivery. On paper, silver appeared cheaper. In reality, it became harder to obtain. This is why attempts to buy at spot failed. Dealers could not restock fast enough. Refineries faced delays. Wholesale suppliers raised premiums to manage demand. The physical market did not validate the paper collapse. This alone should have raised alarms. But the deeper reason demand remained strong lies in how silver is used in 2026. This is no longer a market dominated by jewelry or tableware. Silver has become a critical input for systems that modern economies cannot function without. Its properties are not optional, they are irreplaceable. Silver is the most conductive metal known. It reflects light better than any alternative. It resists corrosion. It conducts heat efficiently. These are not marketing points. They are physical laws. The global energy transition depends on these laws. Solar technology has evolved rapidly. New generation tunnel oxide, passivated contact cells require significantly more silver than older designs. This is not a choice manufacturers can negotiate away. It is a requirement of efficiency. As governments mandate solar adoption and expand renewable capacity, silver demand scales automatically. Each panel installed locks silver away for decades. It does not return to the market as scrap anytime soon. Paper crashes do not change this reality. If the price falls, manufacturers do not cancel orders. They accelerate procurement. Production targets do not pause because a futures contract traded lower in New York. The same logic applies to the artificial intelligence boom. Data centers are being built at unprecedented speed. These facilities require reliability above all else. Failures are costly. Downtime is unacceptable. For high-performance connectors and components, silver remains the preferred material. Substitution is not simple. In many cases, it is not possible. Then there is the demand most investors prefer not to think about: defense. Modern warfare consumes silver permanently. Missiles, guidance systems, satellites, and advanced electronics rely on silver's conductivity. When these systems are deployed, the silver they contain is destroyed. It does not recycle. It disappears. Defense contractors do not speculate on prices. They secure supply. They plan years ahead. Their demand is strategic and price insensitive. This creates a category of buyers who will not step away simply because volatility rises. Against this demand profile, supply looks increasingly fragile. Primary silver mines are rare. Most silver production comes as a byproduct of mining other metals. This means silver supply cannot respond quickly to price signals. Even dramatic price increases do not immediately produce more metal. Ore grades continue to decline. Extraction becomes more expensive. New discoveries remain scarce. This is the structural imbalance that paper traders ignore. On Monday, financial markets treated silver as a leveraged asset tied to currency moves and macro headlines. Physical markets treated it as a scarce input essential to long-term planning. These two views cannot coexist indefinitely. The paper market can dominate price for short periods. It can create violent moves. It can force liquidations, but it cannot manufacture supply. What Monday revealed was not weakness in silver. It revealed tension between two systems trying to impose different realities. One system trades claims, the other moves metal. As prices collapsed, one group exited under pressure. Another group accumulated quietly. The surge in physical demand did not happen despite the crash. It happened because of it. This is why focusing solely on charts leads to misunderstanding. Charts show transactions, not intentions. They show where trades occurred, not why metal moved. To see the real signal, one must follow the flow of ounces, not the flicker of prices. And the flow of ounces continues in one direction. The question is no longer whether demand exists. It clearly does. The question is whether the paper system can continue to suppress price while physical inventory drains away. That question does not get answered on a chart. It gets answered when delivery is requested. And that is where the story becomes uncomfortable for those still believing this was just another volatile day. Because when demand accelerates during a crash, it suggests something is being concealed, not from traders, but from the price itself. The next step is to ask who benefits from this concealment and what happens when it can no longer be maintained, what they're concealing and what comes next. Every major market event has two stories. The public story is loud, emotional, and easy to digest. The private story is quiet, technical, and uncomfortable. Monday's crash was no different. The public story said prices collapsed because confidence vanished. The private story tells a different truth. What is being concealed is not a conspiracy. It is something far more ordinary and far more dangerous. It is a structural advantage held by those who understand how markets actually reset. When prices collapsed, attention stayed focused on who lost: retail traders, leveraged funds, late entrants who bought strength and were forced out at the worst possible moment. Losses were real. Pain was visible, but markets are zero-sum in the short term. If someone is forced to sell, someone else must be buying. The crucial question is not who lost, it is who gained control. The beneficiaries of events like Monday are not emotional participants. They are institutions that prepare for disorder. They understand that highly leveraged markets do not fail gradually. They fail suddenly. And when they do, liquidity becomes more valuable than price. These entities wait for forced liquidation. They do not chase trends. They wait for margin calls to do the work for them. This is how positioning resets without headlines announcing it. When the selling pressure peaked, buying appeared precisely where forced sellers could no longer resist. That is not accidental, it is strategic. Those buy orders were placed long before the crash occurred. They were waiting for stress, not reacting to it. This is what is being concealed by the volatility narrative. The crash was not merely destruction, it was reallocation. History shows this pattern clearly. In May 2011, a similar collapse marked the end of a speculative cycle. Margin requirements were raised repeatedly. Leverage was crushed. Prices never recovered for years. That event burned demand and destroyed confidence. In March 2020, another collapse looked just as frightening. Liquidity vanished across all markets. Investors sold anything that could be sold. Silver collapsed to levels that felt apocalyptic. Yet that event did not end a cycle. It reset one. The difference between those two outcomes was not price, it was ownership. In 2011, physical demand faded alongside price. In 2020, physical demand exploded as price collapsed. That distinction mattered more than any chart pattern. Monday's event shares far more characteristics with the second scenario. Physical demand did not retreat. Premiums widened. Inventories tightened. Metal moved away from Western vaults and toward long-term holders. These are not signals of a dying market. They are signals of stress being absorbed. This is why focusing on short-term price projections misses the point. The critical issue is not whether prices bounce tomorrow or grind sideways for weeks. The issue is whether physical availability continues to drain while paper claims multiply. Because that combination is unstable. The paper market can create the illusion of abundance. It can sell claims faster than metal can be delivered. It can suppress price temporarily by expanding leverage. But it cannot change one fact. Eventually, claims must be settled. And settlement does not occur in dollars. It occurs in ounces. As physical inventory moves east, pricing power follows. For decades, New York and London dictated silver's price because they controlled supply. That control is weakening. As more metal leaves the Western system, the paper price becomes less representative of reality. This is why volatility is increasing rather than decreasing. Volatility is not a sign of healthy price discovery. It is a sign of scarcity meeting leverage. Markets snap violently when buffers disappear. Looking forward, there are only a few possible paths. One path is a false recovery. Prices rise briefly on low volume, luring traders back into leverage. That path ends with another liquidation event. It resolves nothing. Another path is a violent squeeze. If physical demand continues to drain inventory and paper sellers overextend, price can reset upward rapidly as short positions are forced to cover. This outcome is rare, but when it happens, it is sudden. The most likely path is also the least dramatic in appearance. It is consolidation. Prices move sideways. Interest fades. Volatility slowly compresses. During this phase, leverage is discouraged. Weak participants exit quietly. Strong hands accumulate steadily. This phase is uncomfortable because it feels uneventful. It does not reward impatience. It rewards understanding. The danger for most participants is not choosing the wrong price level. It is choosing the wrong framework. Those who view silver as a trading vehicle will continue to be shaken out by volatility. Those who view it as a strategic asset will measure success differently. 1 ounce remains 1 ounce regardless of price. This is the part of the story that rarely makes headlines. The transfer of ownership does not announce itself. It happens during chaos, not clarity. It happens when attention is focused on losses rather than flows. Monday's crash will be remembered as a dramatic day on a chart, but its real significance lies elsewhere. It marked a moment when paper confidence fractured and physical reality asserted itself. What comes next will not be decided by headlines, opinions, or predictions. It will be decided by inventory, delivery, and demand that does not respond to fear. Markets can hide these forces temporarily. They cannot eliminate them. And when concealment fails, prices do not adjust gently. They reset. The question facing decision makers now is not whether volatility will continue. It will. The question is whether they understand what volatility is revealing and what it is trying to hide. Because once the transfer is complete, the window closes, and history shows that when that happens, the price is the last thing to catch up.